So you want to use this time to get some coffee or whatever you want for lunch, etc., etc. And we'll get back to you on this format. And it's person the G20 and connect.
Can you hear what Stan is saying?
I just want to double check if everyone can hear us all clearly. I don't know if it was just Stan's connection or was I, because I was also busy on something and it was coming through a bit blurry, laggy. Jack, can you hear me, Jackie?
Yes, Stan was very unclear. I
Yeah,
can
could
hear
just be
you.
his own personal connection, but I can hear you
Okay.
correct, and you can hear me correctly.
Yes. Yes.
Perfect.
Can you hear me now?
I can hear you, but it breaks up every now and then. But hopefully, it will be fixed. Well, it'll catch up by the time we start.
Let's try this now. Just going to mute it. Now, are you hearing me?
Perfect.
Okay.
Perfect. I can hear you now.
It's a microphone that's plugged in because the laptop isn't loud enough.
It's perfect. All right, we still got a few more minutes before one, and then we'll wait a couple more minutes for everyone else to join. I see people are still only slowly joining in today.
Yes, we'll start officially at 5 minutes past, just to allow everyone, whatever issues there may be. As I said previously, if you need to get something to eat or drink, this is the moment, and we'll get back to you soon.
Hi, Danny speaking.
Okay, it's 1 o'clock. We're going to start at 5 past, as I made a previous announcement. Those of you who have just joined, so take this opportunity to get yourselves ready, and we will be starting at 5 past. People are joining, but seem to be, the take up is a little slow. So just give us a few more minutes and we'll be on the way. Okay, good afternoon, everyone. It's almost time. We're going to start at 5 past. As previously, Prof. Jackie really needs no introduction. Been around and everybody knows her. Jackie, there's a question I put in the chat. If you wouldn't mind just having a look, there was an anonymous question about Section 93. And the person who asked is one of our clients, asked, having problems with getting an answer out of SARS on a Section 93, something to do with what they've submitted. They've done all they had to do, and it's been now 4 months and they haven't had a response. Is there any recourse? Can you get free tax for the next 5 years or punish them in some way? Or
I'm not seeing the question in the chat.
did I not put it in there?
Unfortunately, it hasn't come through. So I don't know. Are you saying Section 93, Section 93
Yes,
of the Tax Administration Act?
Yes. So they're not getting a response. They've waited for 4 months already. Is there any way that what does one do in a case like that?
Look, I mean, based on what you've said, it's very difficult for me to give an answer because I don't quite know the circumstances. So Section 93 is talking about a reduced assessment. So
Yes,
what would be the circumstances that gave rise to the reduced assessment, etc.? It's very difficult to sort of come in without any knowledge of what's happened there. Yeah, so it seems it's not really making a lot of sense to me. I think what might be better is if you send me more info offline and I can apply my mind to it. But yeah, I don't know. It doesn't really make sense to me.
Okay, let me try and
Sorry,
see.
it's
I
just not
can-
enough information.
Got it. Okay, thanks very much.
So maybe just email me separately might be the best.
Right. Okay.
All
Okay, I
right. So
think
would you like me to start?
yes, Jackie. So yes, thanks very much. Thank you everybody for joining, uh, and the floor is yours.
Great. Thank you so much. And good afternoon, everybody. It's lovely to be with you again. And of course, here we are almost at the end of the year, just a couple more. In fact, I think it's only one more working day or so in November, then we're through to December. So yeah, and then we're flying through to the end of 2025. So yeah, I mean that's I don't know what happened to 2025. It just seems to have come and gone in a blur. But here we are, and back to the year-end update again. And as always, we have a lot of things happening in the year-end update. Actually, you know, with all the focus on AI at the moment, I was actually just listening to a little podcast around, you know, different tips of using AI. And the one thing they suggested is there's an AI tool that you can put in a whole lot of information and it'll generate a song for you, which helps with the learning process. So who knows, maybe next year the year-end update will be a song, one long song. Maybe it'll help to make things more memorable, to help to address all of these difficult concepts. But for now, you have my voice in droning on for the next 3 hours and talking about the main tax amendments. So this year, in fact, we've got 4 bills. The one that I haven't mentioned here is the Revenue Laws Amendment Bill. That was a bill that came through very early in the year and has further changes to the two-pot retirement system. And it's been approved. It's just waiting the president's signature. So that'll probably be promulgated quite soon. But then the 3 that we are talking about today are the Rates and Monetary Amounts and Amendment of Revenue Laws Bill. That's what we call the Rates Bill, the TLAB and the TALAB. And we'll spend most of our time talking about the TLAB and the TALAB, the Taxation Laws Amendment Bill and the Tax Administration Laws Amendment Bill. So just so that you can plan your afternoon, we'll run from now through until 2:30. I'll aim to take a break at 2:30, from 2:30 and until, let's say, 2:45. And then we'll run through from 2:45 and finish by 4 o'clock. Okay, so we'll have a 15-minute break at 2:30 if there's anything urgent that you need to attend to. If you're not able to attend to it, you know, it's a lot of people multitask while they watch these webinars, but yeah. All right, so these bills that we are going to be covering today, and of course, the other thing is that if you do have any questions while we are going through, please feel free to raise your questions. You can pop your questions into the Q&A or into the chat box as you prefer. I'll have a look every now and again, and maybe Stan and Danny, you can just help me if you see something. If I haven't addressed it, just draw my attention to it. Yeah, to try and keep it to the matter that we are dealing with so that we can stay on track. Okay, so let's get straight into it then. So the Rates and Monetary Amounts Bill, the process of that bill, so that lists certain rates adjustments announced in the 2025 budget, changes to the transfer duty tables, some changes to the Employment Tax Incentive Act, etc. And those were tabled on the day of the budget speech. Comments were taken into account through public workshops, and then they were introduced into Parliament. Well, actually, they're being introduced into Parliament now, but it is the final rates bill which has been introduced. And that was actually all approved back in April, because all of these things have already come into effect. The transfer duty tables took effect from 1 April 2025. We've had our sin taxes took effect on the date of the budget speech. Employment Tax Incentive Act, those changes came into effect also from the 1st of April. And carbon tax adjustment, 1st of January. And the only other sort of big thing, if you could put it that way, in the rates bill was the notice of cancellation of the proposed increase in the health promotion levy. Although I have been hearing a lot around the health promotion levy in advertising in the media recently, which makes me wonder if we are not being sweetened up, if you want to put it that way, to having another increase next year. So the health promotion levy, of course, is the sugar tax, and that has stayed fixed for the last few years because they had postponed and then cancelled this proposed increase. But yeah, we'll have to see what happens next year. Yeah, it's interesting. Government is certainly looking all over the place to try and find extra taxes. I see that at the moment there's a proposal on the table that has just been released by National Treasury looking at a tax on gambling, online gambling. And well, yeah, it'll be interesting to see if that actually takes hold and how much a tax like that would generate, bearing in mind that it seems that as South Africans, we have become a nation of gamblers. According to the statistics, I think something like 47% of adults in South Africa participate in gambling. Well, I mean, that's really quite an interesting statistic. And yeah, maybe it is something worth taxing, but we already see other sort of things being taxed through alcohol and tobacco, our sin taxes. And a lot of the submissions on this year's budget speech, after this year's budget speech, related to the proposed increase in the excise duties, with the tobacco and alcohol manufacturers vehemently opposing these increases. But nonetheless, they did go ahead. And yeah, it's going to be interesting to see what happens going forward as to whether we get another tax on online gambling. Right. Then moving on to the sort of more meaty amendments that we will be talking about really for the rest of today. And these are the amendments in the Taxation Laws Amendment Bill, the TLAB, and the Tax Administration Laws Amendment Bill. Now, these amendments were proposed in the budget speech. And so if you watch the budget speech presentation that we did back in March, we did give a heads up that these amendments were coming. And of course, that is announced by the minister in the budget speech for the first iteration of the budget speech, which was on the 12th of March this year. And then they have to be turned into actual legislation. So we had the draft bills released for public comment on the 16th of August, and that was open for comment until the 12th of September. There was some workshops with National Treasury, and it was working through these proposed, the proposed amendments that were announced in the budget speech. Now, interestingly, in that submission process, and I know I always stress how important that submission process is, very important to get involved in the submission process if you have any specific knowledge on any of these amendments that are being proposed. Because thanks to the people who did get involved in the submission process, 2 of the proposed amendments were taken off the table. The one was proposed amendments to Section 8E of the Income Tax Act, and that talks about dividends on hybrid equity instruments being treated as income in certain circumstances. So obviously, dividend income is usually exempt, but if it's a dividend on a hybrid equity instrument, it's treated as interest income, and then it's not exempt. And the issue with the hybrid equity instrument is within that definition, it's talking about shares that are convertible or redeemable within or up to a 3-year period. So often looking at the preference share situation. For that reason, many preference shares have a redemption or conversion period 3 years and 1 day or a bit longer. And they were looking at changing that 3-year aspect, but it was causing huge uncertainty, and the pref share market is quite a big market for investment in South Africa. And because of the uncertainty and the proposed negative impact on investment, it was decided to take that amendment off the table. Now, I wouldn't say it's been scrubbed altogether. They have indicated that they may come back and revisit Section 8E in the future, but for now, it's not part of this year's amendments. And the other amendment that I think a lot of people were very happy to hear had been also taken off the table was the proposed amendment to Section 10(1)GC, which is an exemption for foreign pensions accruing to residents of South Africa. And they were proposing to scrap this because they were saying that there's an opportunity to tax these pensions that we are not making use of. But of course, there again, it's going to lead to a lot of uncertainty. We have a lot of people who like to come to South Africa for our South African sunshine, you know, the swallow situation, sometimes here, sometimes overseas. And we want to attract people to come here with their euros, their pounds, their dollars, etc. We certainly don't want to chase them away by saying we're going to tax their pensions. Now, obviously, just visiting here doesn't make them a resident. But if people spend more than 183 days in South Africa over more than a sort of a 5-year period, then you're looking at that physical presence test that brings the person in as a tax resident in South Africa. Then if they end up having to pay tax on their foreign pensions, that's obviously not a situation that they want to be in. So again, it's not creating a friendly environment for bringing foreign currency into this country. And certainly, I think many people were quite relieved at the announcement, which came through early in November or late October, it would have been, that they were not going to go ahead with that proposed amendment. So 2 amendments off the table, and now we'll go through and see and work through the other amendments that are still there. So these are in the final bills that were tabled. I've just realized after 2 weeks of looking at these slides that this is should be past tense, on the 12th of November 2025. All right, so that was when the minister presented his medium-term budget speech. There were these 3 bills that were tabled at the same time, the rates bill, the TLAB, and the TALAB. Not much was made of these bills because all eyes were on the announcement around the 3% inflation target. But this is something that always happens at the medium-term budget speech, is that the bills are then tabled, and that means that they're starting the approval, the formal approval process of actually going through Parliament. Now, they've obviously been through the submission process. They've been considered by the Standing Committee on Finance, which is the parliamentary committee which is mandated with overseeing these types of bills. And you know, that they've given the go-ahead subject to those 2 amendments being taken off the table. So my expectation is we probably won't see any further changes. Sometimes, as the exception to the rule, we do see some changes happening to the final bills after they've been tabled in Parliament. But it is the exception rather than the norm. And I'm not really expecting that we're going to see anything this year, unless we see something around the schools amendment on the VAT, but that remains to be seen, and I'll come to that a bit later on. Now, you might say, why do we have 2 bills, you know, the TALAB and the TLAB both coming through at the same time? Well, the TALAB obviously deals with your money aspects, the financial aspects, things that have a financial aspect, and those are money bills. So when you got changes in taxes, levies, or anything affecting tax payable, then that comes through and it gets approved under Section 77. And ordinary bills, which only have administrative provisions, and that will be your TALAB, which includes changes to not only the Tax Administration Act, but also the Income Tax Act and the VAT Act. Now, that goes through a slightly more simplified process because it doesn't have financial implications, and that goes through Section 75. All right, so just on the sort of parliamentary law, that's why we have 2 separate bills. Now, if we have a look at the TLAB then, the Taxation Laws Amendment Bill, there's quite a number of amendments coming through, as you can see listed here. We're going to be talking through most of these things, so I'm certainly not going to read through the list, but just to give you a sense of what is coming through there. And then there's also more. There's more on the next slide. International aspects you can see coming through. We'll talk about, sort of 4 of those 5 things mentioned there. I'm not really going to go into the definition of equity share, but just to make a mention that it has been amended. And then your VAT amendments, and most of these VAT amendments are fairly sort of administrative, procedural in nature. And so we're not really going to go into the nitty-gritty of them. I'll just talk about the testing services as just an interesting one, the definition of insurance, also just from an interest perspective, and then also educational services. So that's a change affecting schools that could have cash flow implications for certain schools. Right, so let's go straight into it. So these are all the TLAB amendments we're talking about now. And this is an amendment in the Income Tax Act, Section 1, amending the definition of remuneration proxy. Now, remuneration proxy is a term that affects certain applications of other provisions in the Act, and especially if you're looking at the provision of the fringe benefit in the form of free or cheap residential accommodation. We have a formula that is used as one basis of working out the taxable value of that fringe benefit. And that formula in the 7th schedule is on the basis of what we call remuneration proxy minus your tax threshold amount 95750 for this tax year. And then you take, so the excess of remuneration proxy over the tax-free threshold multiplied by a percentage and then possibly apportioned. So the idea with the remuneration proxy is that we are essentially basing that valuation on the level of the person's remuneration, but we don't know what their annual remuneration is for this year, and it gets very messy if you're going to be working on a month-by-month number. You want to have something that is pretty standard through the year. And so instead of trying to guess what this year's remuneration is going to be, we use this remuneration proxy, which means we look back and we say, what was this person's remuneration in the previous year? And then we use that as our proxy for remuneration in the current year in order to do that calculation. And it also comes through with a benefit with low-cost housing, people's remuneration proxy up to a certain amount, I think it's 350,000, can benefit from this low-cost housing provision and so on. So remuneration proxy, giving you a number to work with based on last year's remuneration. But when we look at last year's remuneration, of course, it is possible that some of that remuneration, or maybe all of that remuneration in the previous year, was exempt, especially if we look at this foreign employment income exemption under Section 1010, and especially when you look at Section 10102, people working outside South Africa for more than 183 days, etc., their remuneration could be exempt, the remuneration earned while they're outside South Africa, exempt up to that maximum amount of 1.25 million. Now, if you think about a practical example here, if you had somebody who was working outside of South Africa, well, they spent the 183 days, more than 60 days continuous in the previous year of assessment. And so let's say all of their remuneration the previous year was actually exempt under that provision. But now they're back in South Africa and they're getting residential accommodation. And now we're working out the taxable benefit. And so we start with remuneration proxy. What was their remuneration last year? Well, it was all exempt, therefore it's nil. And so SARS is saying, well, that's creating unintended tax advantages, because now we are, for a whole year, we're going to have a nil value on that residential accommodation. And so for that reason, they're saying we need to get a more realistic number for this remuneration proxy. And to do that, if there was any amount exempt in the previous year under Section 1010, and of course that doesn't apply only to 10102, it could also be Section 10101, which talks about officers and crew members, as well as Section 10102, which is that 183-day story. So if the remuneration was exempt under any of those provisions, then actually when we work out remuneration proxy, we have to add that amount back. So you're getting to a gross number as opposed to a net number, and that becomes the remuneration proxy for this year. So it's a way of closing a, can we call it a loophole, broadening the tax base with the objective of getting more tax revenue. And I must say that is a common theme through all of the amendments this year, is that you can see time and time again that they're all amendments that are designed to generate more tax revenue going forward. So this amendment will be effective for the next tax year, years of assessment commencing on or after 1 March 2026. Yeah, quite an interesting one. And talking of interesting, now we get on to a bit of a discussion around interest. And to start with, I just want to focus on this provision, Section 11G, because we've got a small change coming into Section 11G in this year's amendments. But it is a good opportunity to talk about Section 11G, which is actually going to become effective from the 1st of January next year. So Section 11G was actually introduced into the Income Tax Act back in 2023, but it hasn't become effective yet. And this is the provision that is going to replace Practice Note 31. And Practice Note 31 has been used quite broadly by taxpayers over many years. Practice Note 31 has actually been around since 1994. And it enables taxpayers to claim deductions of expenditure incurred in the production of interest income where they are not carrying on a trade. So ordinarily, in order to get a deduction, you would have to show that that expenditure has been incurred in the production of income in the course of carrying on a trade. But the practice note 31 enables a deduction even if you're not carrying on a trade. So it's a concession that has been granted. But, and let me just jump forward and then I'll come back to these slides. So it's a practice of SARS to allow the deduction of expenditure incurred in the production of interest income, even when the taxpayer is not carrying on a trade. Notice here it talks about the deduction of expenditure incurred in the production of interest income. All right, but it does then limit if the taxpayer is not actually carrying on a trade, if they're not incurring that expenditure in the course of carrying on a trade, then the deduction of expenditure in terms of practice note 31 would be capped, or is limited to the amount of interest income. And any excess would simply be lost. You can't create an assessed loss and you can't carry that excess forward. All right, so that's practice note 31, and we were told in 2022 that SARS intended to withdraw. In fact, initially they were just going to withdraw practice note 31, and there was quite an outcry. And so then they said they're going to replace it with a legislative amendment. They also spoke about practice note 37. We haven't heard too much more about that. But certainly with practice note 31, this section 11 capital G is the legislative provision that replaces practice note 31. And so SARS did give a bit of a story about government policy that, you know, they should be carrying on a trade and there's a concession, but they don't want to make the concession too broad. So as I say, that then gave rise to section 11G. It took a couple of iterations to get to the final version that was then promulgated in the 2023 Taxation Laws Amendment Act. And if we look at the wording of section 11G, it comprises 3 subsections. So it talks about what is interest. It defines that in terms of section 24J. And section 24J1 has quite a broad definition of interest. So it's not just your money charged for, you know, borrowing or taking out a loan. It's not just that ongoing interest that may be charged, but it can include other related expenditure. Well, expenditure related very specifically to the loan that has been raised. So things that are similar to interest, okay? So it talks about interest or similar finance charges, discounts, premiums, etc. on a financial arrangement. So it is a fairly broad term, but it is, you know, it does refer to interest. And then in section 11G2, it says for the purpose of determining the taxable income derived by any person, there will be, and that means any person, right? Companies, trusts, individuals. There will be allowed as a deduction from the income of that person, interest incurred by that person to the extent that the interest is incurred in the production of interest income and is not incurred in the carrying on of a trade. So 11G applies where we have interest income, not by carrying on a trade, but from investments. And then we would be able to deduct the interest incurred in producing that interest income. But notice here, it only allows the deduction of interest incurred, whereas practice note 31 is more broad. It allows the deduction of expenditure incurred in the production of interest income. It also brings out the point that when we say here, it's interest incurred to the extent that the interest is incurred in the production of interest that is included in income. So if there's interest that is exempt, you would not be able to deduct any portion of that expenditure that produces exempt income. So if you, let's say we have a taxpayer who raises a loan and pays interest of 60,000 Rand on this loan during the year and invests the money from the loan in an interest producing investment, and from that, he gets interest of, let's say, 50,000 Rand, okay? Now, as an individual, let's say under the age of 65, they would get that 23,800 local interest exemption. So of the 50,000 interest that they're earning, almost half is exempt under 23,800 and just over half is taxable. And so that same apportionment of what is taxable in relation to the total amount of interest earned, you'd have to apportion that same amount of interest expenditure. So you can't deduct the whole 60,000. You'd have to apportion the 60 between what is earned on exempt and what is earned on taxable interest income. And then, having done that, the deduction against taxable interest income is then, in terms of subsection 3, capped at the amount of that interest income. All right. So in my example, if you wanted to deduct 30,000 against interest income of 25,000, your deduction would be limited to 25,000, and the excess would be lost. You would not create an assessed loss. You would not be able to carry it forward. All right, so it's an important provision, and it's really important to take note of the fact that 11G is coming into effect from 1 January 26 for years of assessment commencing on or after that date, and that Practice Note 31 remains in place until then. So for individuals, trusts with a February year end, you're still going to be using Practice Note 31, even for companies with, a February year end. You'll be using Practice Note 31 up to the end of February 2026. And then from the 1st of March 2026 going forward, no longer can you use Practice Note 31. It's deemed to fall away when 11G comes into effect. So then you would have to use 11G, even though 11G is more limited than Practice Note 31. And then what is changing in terms of 11G this year is that they are introducing just these little words where it says, let me just go back here, for the purpose of determining taxable income, they'll be allowed as a deduction, etc. They're introducing here the word saying, notwithstanding Section 23B. All right, so you can disregard, even though Section 23B might prohibit the deduction of private expenditure, if you have interest incurred, let's say on a bond, and you've invested that money to earn interest income, you would still get this deduction under 11G, but subject to the limitations of scope that apply in the Section 11G provision. And so this amendment that's coming through in the current year's bill, which hopefully will become an act by the end of the year, but this amendment comes into effect also 1 Jan 26 for years of assessment commencing on or after that date. So to tie in with the effective date of Section 11G. Right, and I think there are a couple of questions here. Let me just have a look. Freelance income. No, George, this is talking about interest income. So yeah, I'm not sure if I'm misunderstanding your question, but this is talking about interest income. And then does this mean that there can no longer, this is from Anonymous, does this mean there can no longer be interest raised on a shareholder's loan account, credit to the individual and taxed in their hands, and the debit being an interest expense in the hands of a company? So the thing is, look, if the company has a shareholder's loan account, so effectively borrowing money from the shareholder, can the company charge interest on that loan account? Certainly. And if it depends what the loan account has been used for. Right, because I mean, if that loan account has been used, let's say the company is carrying on a trade, the shareholder has lent money to the company, and the company has used that to buy machinery to produce widgets, which is for the company's business, then obviously in that situation, the interest would be allowed as a deduction. So that's not an issue if the company is carrying on a trade. So 11G as it becomes effective if the company was not trading. So use all the same facts, but then the company borrows this money from the shareholder, not to buy machinery, but to invest. Maybe it's an investment company. It's not actually trading. And it invests this money in order to earn interest. So there, your deduction of interest, whether it be on a shareholder's loan account or anywhere else, it could be limited in terms of Section 11G. But the other point of this is that, of course, this is where the company is borrowing money on a shareholder's loan account. If the company was lending money to a shareholder, of course, that's a different scenario, because if you don't charge interest there, then you would end up possibly with a deemed dividend situation under Section 64E4. And then John says, so a company that was investing funds which generated mainly interest income and had expenses other than interest. Yeah, so this is the problem, is that the other expenses, once we move out of the Practice Note 31 dispensation into the Section 11G dispensation, then if you're not carrying on a trade, so if you don't meet the trade requirement, which pushes you then into 11G, then you only get deductions for interest expenditure, not for any of these other things. All right, so yes, it's going to have a much more limited application. It's very important to bear that in mind going forward. That is, if you don't meet the trade requirement. If you meet the trade requirement, then you'd be looking at your interest deduction under Section 24J2. And there it's got to be interest incurred in the production of income in the course of carrying on a trade. But that would be no issue around claiming that interest as a deduction. And then, of course, your other expenses, if you're carrying on a trade, you deduct under the general deduction formula. But if you're not carrying on a trade, you can't deduct your other expenses under the general deduction formula. And 11G limits you only to a deduction of interest, not to any other expenses. Yeah. So it is really important to take note of the fact that the scope of 11G is much more restrictive than what we saw under Practice Note 31. Okay. Right, so we can then move on to the next amendment. I don't see any other questions coming through there. This is quite a quick and easy one. It's just that the Section 12L incentive is being extended for another 5 years. It was going to end at the end of this year, but it's going to go through for another 5 years for any assessment year ending before 1 January 2026, so up to the end of December 2031. Yeah, up to the end of December 2030. And similarly, we see the Section 13 quat incentive being extended. It was the sunset date initially was 31 March 25, and that's been pushed out by 5 years to 31 March 2030. That's for your urban renewal and development. Right. Then we get on to the next amendment, which deals with Section 18A. Now, we're going to come to an administrative amendment a little bit later on around Section 18A. But this is an amendment, and according to the explanatory memorandum, to clarify the amount of taxable income on which you have to base your 10% limitation. Because, of course, Section 18A allows a deduction of donations made to a Section 18A entity, let's say a charity which has been registered with Section 18A status. When you make a donation, you get a Section 18A receipt as the donor, and then you would look at claiming your Section 18A deduction. But that deduction, of course, is limited to 10% of taxable income. And there seems to have been some confusion around what taxable income exactly do we mean, because there's lots of different things that come into taxable income at different points. So currently, Section 18A, subsection cap B, currently says that it's 10% of taxable income. And it already says, excluding lump sums, it already says before allowing any deduction under this section or Section 6 Quat 1C. So what's being added in is to say, or setting off a balance of assessed loss under Section 21A 1 or 2. All right, so if you're doing a whole taxable income calculation, gross income minus exempt income minus all your various deductions, allowances, etc., add in your taxable capital gains under Section 26A. So that would come in before this step over here. And then you would say, right, what is my taxable income before 18A, before 6 Quat, before setting off the assessed loss? That is the amount on which you base your 10% to limit your 18A deduction. All right, and then, of course, you take off 18A, take off 6 Quat, then you set off your assessed loss. I do think that they need to make a small amendment to the amendment here, because they say before setting off an assessed loss under Section 21A 1 or 2, which really just refers to your set off of assessed losses by your companies. 24A1 talks about your mining companies. 21A2 talks about your non-mining companies. And in either case, with a company, the set off of the assessed loss is limited to the greater of R1 million or 80% of current year's taxable income. That limitation doesn't apply to taxpayers other than companies, and their set off is allowed under Section 21A subsection 3. And so surely when they talk about setting off a balance of assessed loss, it must be by any taxpayer, not just companies. So I do think they need to fix this. It's a little typographical error. that has come in here. But the point here is that you're going to calculate your 10% limitation before setting off any balance of assessed loss. And then we get to the amendment around section 20A. And not, oh, let me just see, I see there's another question here. Where's that gone? There we go. Where banks charge a management fee on monies invested. No, okay, so that links to what I was saying just now, is that, no, if it's just an investment, then going forward with 11G, there's no deduction of any expenditure other than interest incurred. Right, back to section 20A, and now we're looking at section 20 cap A, right? Not 21A like we looked at on the previous slide. Section 20A talks about ring fencing of assessed losses. And it's a provision that only applies to natural persons, individuals, and it applies to natural persons who have taxable income exceeding the rate at which the maximum marginal tax rate applies, which is currently 1.8 million rand. So it's only those taxpayers who are affected by section 20A, and that means there's not that many taxpayers affected. But SARS has now said, well, they think that this is a bit of a loophole. They say that the application allows taxpayers below that maximum marginal threshold to exploit the tax system by continuously offsetting losses from trades against other income sources. Now, this, of course, does link to section 20, which allows the set-off of an assessed loss from one trade against taxable income from another trade within the same year of assessment. However, this ring fencing provision says that if section 20 cap A applies, then that set-off would not be permitted. The loss from the one trade would have to be ring fenced, carried forward, and considered for set off against any future taxable income from that trade. All right, so this issue about people being able to set off their losses against other taxable income, in the explanatory memorandum, they say that is resulting in people getting refunds of employees' tax. So if you think about somebody who might be in quite a high-paying position, maybe they're earning remuneration of, I don't know, maybe you take one of these city officials from Johannesburg that we recently saw earning like 4 million rand a year. And then they might have a secondary trade going on, which is making a loss. And they would be looking at setting that loss from the secondary trade off against the remuneration taxable income. But in that case, if the person's remuneration is 4 million rand a year, they are clearly above that 1.8 million rand threshold. So depending on the secondary trade, it is possible that section 20 cap A could apply in that circumstance. But SARS and National Treasury feel that not enough people are subject to section 20A, and so they are making amendments to reduce the threshold at which section 20A becomes applicable. So it'll no longer be at the 45% threshold. It's going to kick in at the 39% threshold, which is taxable income of 673,000 currently. But this will become effective for the next tax year, so years commencing on or after 1 March 2026. So this 673 might change depending on the tax tables next year, but it'll be whatever the threshold is at which 39% tax rate applies. So the expectation is many more people would become subject to section 20A. So let's just do a quick recap. When does section 20A apply? So as I've said, it applies to natural persons, and it has this threshold of taxable income, the taxable income before setting off any assessed losses, of course. And so that's reducing. But when it would apply is when you have one of two circumstances. Either you have this natural person who has a loss that has been, he has a trade, a secondary trade, that has been making losses factually and in 3 out of the last 5 years, including the current year. Okay, so 3 out of the last 5 years, there have been losses from this trade. It might be a fully bona fide trade. Maybe they own a franchise selling hamburgers on the street corner, but they've been making losses 3 out of 5 years. So that could trigger section 20A. Or if they have a suspect trade that is carried on. And there are 8 suspect trades. In fact, there are 9, but the first one the first two is almost a repetition of the same thing. I'll show you those 8 suspect trades. But the point here is that if someone is carrying on a suspect trade as listed, even the first year that they make a loss from that trade, they could be subject to Section 20A. However, whether they fall into the 3 out of 5 year bracket or the suspect trade situation, there is a safe harbor, an exception rule in Section 20A3, which would then throw you out of Section 20A. All right. Now, this all becomes quite complex. SARS does have a guide on this provision. I do just have to warn you, though, that this guide has not been updated for quite some time. So the rates and tax tables, etc., used are quite outdated. Nonetheless, the principles in this guide still remain relevant. So it could be useful, and I'm really hoping that by next year, SARS has updated this guide, because we will now have so many more people affected by Section 20A. Right, so I said it's either 3 out of 5 year or 8 suspect trades. What are these suspect trades? Well, the first 2 relate to rental of residential accommodation or rental of vehicles, aircraft, or boats, unless at least 80% is used by non-relatives for at least half the year of assessment. Okay, so if you've got rental property that you're renting to a family member, a relative, you make losses on that, that is regarded as a suspect trade. But if you are renting to independent third parties who are not relatives, then that's not a suspect trade, but you could be caught by the 3 out of 5 year rule. All right, the other suspect trades: farming or animal breeding, sport, dealing in collectibles, animal showing, performing or creative arts, betting or gambling if it's carried on as a trade, and then trading in crypto, buying or selling any cryptocurrency. All right, so if you've been dealing in crypto, or you just started dealing in crypto and you end up having made a loss in this year, that's a suspect trade. And so that loss could be ring-fenced under Section 20A. If you are having taxable income above, in the future, it'll be 673,000. However, what is the safe haven or the safe harbor rule? So the ring fencing won't apply if the taxpayer is able to show that the trade constitutes a business with a reasonable prospect of deriving taxable income within a reasonable period, having regard to various factors, looking at profitability, activity, etc. You can see this is explained in more detail in the SARS guide. So this is really what we call a facts and circumstances test. Based on the facts and the circumstances, are you as the taxpayer able to put together a business plan showing that even though this trade may have made losses in 3 out of the last 5 years, or maybe it's a suspect trade that has been making losses, but there is a reasonable prospect of becoming profitable within a reasonable period. However, that's not going to help you if you've actually made assessed losses in 6 out of 10 years, ending on the last day of the year of assessment. All right, so although that doesn't apply to farming, because it's recognized that farming can take a long time to turn around. But if you have a rental property, and let's say that it's not a suspect trade, it might just be rented to a tenant, and initially your interest is greater than the rental on that property. So you end up with a loss situation. Now, what would ultimately happen is that, and this is why you are investing in a rental property, is that that rental will keep increasing by inflation, whereas the interest would kind of stay the same or maybe even come down depending on your capital repayments on the loan. And so there will come a point where there's a crossover where this rental does become profitable. But that might be only 10 years in the future. If that is the case, after 6 years of making losses, you are not going to be able to argue your way out of the ring fencing because you factually made losses in 6 years out of a 10-year period. And then what will happen is that the ring fencing will apply. If you are a natural person with other taxable income above the threshold of now 673,000. So if the ring fencing applies, it just means that the loss from that trade can't be set off against your other taxable income in that year. The loss gets ring fenced, carried forward, you don't lose it altogether, and then you would look at setting that off in the following year. So if your secondary trade is then making a profit in the next year, you would set that loss off against the profit of that secondary trade in the following year. So it's ring fenced to that trade, and it'll be set off in the following year. All right, so it is quite a nasty provision if it applies, because it certainly has a cash flow implication initially. So even though you don't lose your loss altogether, but timing is critical, and it means that initially you're not going to get the benefit of the set-off, but you'll get the benefit later on when this secondary trade starts turning a profit. Okay, so the changes to Section 20A coming into effect from the 1st of March 2026 and going forward from there. I don't see any other questions on that, so let's carry on then. Okay, so the next one that we can look at, your asset for share transactions. So now we're getting it very much into the corporate space after having been in the individual space looking at Section 20A. The Section 42 asset for share transaction provision, it falls within our corporate reorganization rules in Part 3 of the Act. And there is a benefit if you can qualify for the Section 42 rollover, because ordinarily when you sell an asset, if you've had an asset, you've claimed allowances on that asset, and now you sell the asset, there would be a recoupment of your past allowances, or maybe a capital gain, maybe even both. You might have a recoupment and a capital gain on the sale of that asset. But if you qualify for the asset for share transaction provisions, the sale of that asset wouldn't trigger any tax implications for the seller. The asset would simply transfer into the company, the acquisition company, at that base cost, the same base cost as it was in the seller. So you just have a rollover of the tax value of that asset. So that's quite a benefit. And there's a similar benefit with share for share transactions, and especially between listed companies. So we have relief when shareholders exchange equity in a target company for newly issued shares in an acquiring company, subject to certain anti-avoidance rules. And these ensure that the acquiring company inherits the target shares with the same tax character and cost as held by the original shareholders. So if they were held as trading stock, the acquiring company holding as trading stock. If held for capital, acquiring company holds as capital. So that same tax character that carries over. But what about listed share for share transactions when you've got thousands or millions of shareholders? It's very difficult, if not impossible, then to track back and see whether this same tax character is going to carry through. And so they introduced a special provision in 2010 for listed share for share transactions, allowing the acquiring company to treat the shares as being acquired at market value, simplifying compliance and removing the need to trace historical attributes for minority shareholders. So effectively, your acquiring company gets a stepped up base cost. Instead of bringing that asset in at original tax value or base cost, you bring it in at current market value. So it is a benefit, but it's intended in these listed share for share transactions when there's a myriad of shareholders. This is supposed to be only a concession given to your minority shareholders, because there's just so many of them and it's very difficult to track everything through. Now, to qualify for the special rollover relief, you have to meet certain criteria. Listed share for share, so both companies must be listed, acquisition and target company, and the acquiring company has to obtain a sizable interest. At the end of the transaction, they must hold at least 35% of the shares in the target company. That could go down to 25% if no other person has an equal or greater interest. All right, so that special rollover relief can apply, but it's supposed to apply to minority shareholders not holding more than 20%. So those who are selling out, all right, they're selling out in terms of this share for share transaction, and they're getting other shares in exchange, but they just kind of been swept along with this transaction. They are minority shareholders. So the amendment is going to clarify that the special relief mechanism only applies to shareholders that hold less than 20%. So it's a provision that comes through a number of sub-paragraphs, just clarifying shareholders that hold less than 20%. Okay. And that's going to come into effect from 1 January 26 and apply in respect of years of assessment commencing on or after that date. Right, and then we get to quite a complex amendment, Section 9D, and it's an amendment to Section 9D. You'll see what they're doing is they're adding in an extra proviso here to Section 9D2A. And the proviso refers to Section 9H3B. So let me just seek to explain this in a reasonably simplified manner without getting too bogged down, because Section 9D is probably one of the most complex provisions in our tax legislation. But if we think about the purpose of Section 9D, it's an anti-avoidance provision, and it was brought in when South Africa moved into the residence basis of tax back in 2001. And it was brought in to alleviate or to prevent a tax leakage that could come about if you had residents that set up offshore companies, foreign companies, investment companies holding offshore assets. And then the investment returns on those assets would flow into the foreign company and wouldn't be taxed, well, this was the hope, wouldn't be taxed in the South African resident until a dividend was distributed. However, Section 9D says if this foreign company is a CFC, and that's a foreign company where more than 50% of the shares are held collectively by residents, if it's a CFC, then there could be an attribution. Part of the net income of the CFC has to be taxed in the hands of the South African resident shareholders on a year-by-year basis. So you don't wait for the dividend. We have this attribution. We bring in part of the net income of the CFC, and that gets taxed in the South African shareholder on a year-by-year basis. And that's done through a determination of net income. So to determine net income, you take in the foreign company and you're saying, if that foreign company was a resident, what would the taxable income be? So it's a hypothetical calculation. And then based on that, what would the South African tax liability be? But there's a comparable tax exemption that says if that CFC is actually paying foreign taxes, at least 67.5% of what the South African tax liability would have been had that CFC been a resident. It's called this comparable tax exemption. In that circumstance, the net income would be nil, and there would be nothing that comes into the taxable income of the South African shareholder. Now, what's coming through this proviso is to clarify that when we are working out the net income of a CFC, we have to include the exit tax that comes through Section 9H, specifically Section 9H3B, and that's an exit tax that arises when a CFC ceases to be a CFC other than by becoming a resident. Now, Section 9H, which creates an exit tax, doesn't only apply to CFCs, of course. Any person who ceases to be a resident is deemed to have disposed of all of their assets other than South African immovable property, assets connected to a permanent establishment in South Africa, or your retirement interests. So any other assets like share portfolios and so on, there's this deemed disposal when a person ceases to be a resident. That gives rise to the exit tax. So what would happen is the person's deemed to have disposed of their assets at market value. Let's say they have a share portfolio. They bought the shares at 100,000. The market value of the shares is now 1 million. You would say we've got a deemed disposal at 1 million rand proceeds minus 100,000 base cost. We've got a capital gain of 800,000. If we're talking about an individual here, we've got to include 40% of that in the individual's taxable income in the year immediately before they cease to be a resident. Okay, so that's the exit tax that comes in. But now we're talking about an exit tax in a CFC. And it's where a CFC ceases to be a CFC other than by becoming a resident. And how would that happen? Well, a CFC being a non-resident is a CFC because more than 50% of the shares are held by residents. So if it ceases to be a CFC, it's because no longer are more than 50% of the shares held by residents. So that could be because your residents, one or more of them, have sold their shares in the foreign company, sold them to non-residents, or possibly those South African residents, or some of them, have ceased to be residents, so they've become non-resident. As a result of that, you no longer have more than 50% of the shares in the foreign company held by residents. And that means the CFC ceases to be a CFC, triggering Similarly, this exit charge, the CFC is deemed to have disposed of all of its assets at market value, etc. Now, the issue here, of course, it gets quite complex, but the bottom line of it is that the current wording didn't always trigger the exit charge that National Treasury wanted to see in that CFC when it ceased to be a CFC. And so they've now introduced this proviso that will make sure that you have to include that deemed disposal, all right? And that would mean that it's going to push up the taxable income in that CFC because you bring in a taxable capital gain. All right. So in those circumstances, you're pushing up the taxable income. And that means that the hypothetical, what would the South African tax be if the CFC was a resident? That SA tax is going to be higher because of the exit charge. And it means it's less likely that the foreign taxes, all things being equal, they will no longer meet or exceed the 67.5%. That's what they're aiming at. And so then the CFC would not be able to avoid the application of that attribution. Okay, so this provision is going to say, this extra proviso, the taxable income of a CFC must be increased by the taxable income resulting from the application of Section 9H3B, the exit charge when a CFC ceases to be a CFC other than by becoming a resident. Okay, so that's going to come into effect from 31 December 25 and applies in respect of foreign tax years of CFCs ending on or after that date. All right. So the way that 9D works is it'll say what is the net income of the CFC during its year of assessment. So if we're talking about a year of assessment ending 31 December 25, and if you come back to a South African shareholder, maybe an individual who has a February 26 year end, so whatever the net income was for the December 25 CFC year end, you'd bring the percentage of that net income into your South African shareholders' taxable income for the year of assessment spanning that date. So it'll be in February 2026. Very complicated, I know, but for those of you who are dealing with CFCs, it's quite an interesting one to take note of. On a simpler matter, now we come back, we're still in the sort of international tax arena. And this amendment here, looking at the interaction between 6 Quat and 23M. Now, Section 23M, as you know, is a prohibition on deduction. So it tells us that an individual who is earning remuneration cannot deduct any expenditure except certain specific expenditure that is excluded from Section 23M. So 23M is a prohibition, but there are some things that are excluded. And these are things like contributions to funds that can be deducted under Section 11F, allowances, expenses, under 11C, legal fees, E, wear and tear, I and J, your bad and doubtful debts, and then 11N, A, and NB, which is amounts income that subsequently has to be refunded. So those are the only sort of, 3 different scenarios where deductions would be prohibited. Oh, yes, then of course you've got your deduction under 11A or D linking to a dwelling, etc. Now, they've said 6 Quat 1C should also be one of these permitted deductions. And so it's taken them a long time to realize that, this is unfair, that employees can't deduct 6 Quat 1C. And so they're amending 23M to bring that in as another little subparagraph where the deduction will be allowed. So 6 Quat 1C allows a deduction for foreign taxes. We often talk about the 6 Quat rebate, which is a rebate or credit for foreign taxes paid by residents on foreign income that is taxed in South Africa. But sometimes there's income like fees and so on for work done in a foreign country, which is then subject to a withholding tax by that foreign country. And that then doesn't qualify for the 6 Quat rebate, but it might qualify for the deduction. All right, so we saw the deduction referred to just now under the 18A amendment. And so this is just saying with an individual who is earning remuneration and would ordinarily have Section 23M prohibiting their deductions, but going forward, this deduction will be allowed. It will be an exclusion from Section 23M. Okay. And then we go on to exchange differences. So also in the international tax arena, Let me just see if there's a question here. Does the capital gain on a 9H disposal ever fall into a double tax agreement? Not as far as I'm aware, because it's the 9H disposal arises from a deeming provision, which is what the courts have referred to as a statutory fiction. It's not a factual disposal. All right, so it wouldn't actually be, it wouldn't get protection from a double tax agreement. So double tax agreement can sometimes refer to disposal of property, etc. But there's not an actual disposal here. It's a deemed disposal. So it wouldn't get that protection. And then John says, if a South African shareholder was not taxed due to the CFC having a foreign business establishment, does the exit tax still apply? No, because what would happen is that if you've got a foreign business establishment, then you actually are not a CFC. Okay, so Section 9D, as I say, is a complex provision, and there's a number of different layers that you have to have a look at. But the starting point would be, have I got a foreign company, more than 50% held by residents? And then the next thing would be, do any of the exemptions under 9D9 apply? And that foreign business establishment is one of those exemptions. So if an exemption under Section 9D9 applies, then your foreign company is not a CFC. All right. So so it wouldn't actually then come in. Okay. Right, let's go on to exchange differences, and that is sort of still a little bit complex here. This is all good to cover the stuff before the tea break. We're going to have a nice strong cup of coffee when you take a leg stretch just now. So deferral of exchange differences. Now, here we're talking about gains and losses on foreign exchange, and this all links to the Rand exchange rate. And it links Section 24I, basically talks about how your foreign exchange gains and losses are taxed. And it is focused on exchange items. And an exchange item is defined as a loan. It can also be a unit of currency, all right, or a debt, a loan, forward exchange contracts, foreign currency option contracts. That's really what we're looking at. So if you took a situation of let's say, a loan, a US dollar loan, and you had a company that had a 10 million US dollar loan that was outstanding right through the year of assessment. We're just keeping it fairly simple here. So on that US dollar loan, obviously you'd have to be translating that to rands. And you would have to say, what is the exchange rate, the rand dollar exchange rate at the beginning of the year, at the end of the year, and the movement in that exchange rate is going to translate in either into an exchange gain or an exchange loss for the year. Okay, so if it's an exchange gain, Section 24I says that that must come into taxable income. And if it's a loss, it can be deducted in determining your taxable income. All right, so it affects your taxable income calculation, except where Section 24I10A applies. And this is a deferral provision. And so here it would say you can defer these exchange gains or losses. You don't have to bring them into your taxable income calculation, but that applies very specifically on long-term intercompany debt that is not classified as current under IFRS. So that's the current application. And this was introduced in 2012, the explanatory memorandum tells us. The goal was to simplify compliance and reduce income volatility from unrealized forex movements by deferring taxation until the exchange item was actually realized. But it's only in this intercompany loan situation. So debtor and creditor are both companies with common shareholders, etc. Now it's come to light that some taxpayers may delay in realizing exchange gains to avoid triggering your taxable income, and that distorts taxable income and revenue timing. So what they're saying going forward is that your tax treatment under 24I10A, this deferral, will only happen if you are basically doing that for accounting purposes as well. They also make the point that there's also challenges when loans are written off and no longer appear. So for accounting purposes, you've impaired a loan, we've written off loan, so it no longer appears in the financial statements. And yet, for tax purposes, you still have this deferral. And so that's creating confusion and uncertainty. And they're saying going forward, you will only be able to have the deferral under subparagraph 10A if you are actually deferring for accounting purposes. Exchange differences on items not recognized for financial reporting would not qualify for deferral, and deferred exchange differences must be triggered on any portion of an exchange item that is realized within the year of assessment. And that means also if you write off a loan for accounting purposes or you impair a loan, that's going to be regarded as being realized. And that would then mean that any exchange gains and so on must then be brought to account at that time. So that'll come into operation from 1 January 26 and apply in respective years of assessment commencing on or after that date. Then, before we take a break, let's talk about trusts and beneficiaries. The perennial favor. I think virtually every year we are seeing amendments around trusts. Maybe after this, we'll take a bit of a break from these amendments. But for now, this continues this ongoing trend that we've seen for many years. If it's not amendments to Section 7C, then we've seen amendments to Section 25B, and now we're going through to the attribution rules in Section 7. Now, of course, if we look at how all of these work together, when we look at the key provision applicable to trusts, which is 25B, and Section 25B really legislates that flow-through principle, whereby an amount that has been received by a trust that then distributed to a beneficiary, if the beneficiary is a resident, that flows through, it's taxed in the hands of the beneficiary. If the beneficiary is not a resident, it's taxed in the trust. But all of that is subject to Section 7, because Section 25B1 is subject to Section 7. And so if there is a donation situation and the donor is still alive, and this income that's coming to the trust, if that arises because of a donation, settlement, or other similar disposition, then it's possible that Section 7 might apply and cause the income to be taxed in the hands of the donor. So actually, there's three possibilities here with income flowing into a trust. It could be taxed in the hands of the donor, if Section 7 applies, or the beneficiary, if Section 25B applies. Otherwise, it's taxed in the trust itself. It just depends on the situation. The flow-through principle of 25B ensures that distributed income retains its original nature and is taxed in the hands of the recipient. Okay, but when it applies, the 25B, as I say, applies subject to Section 7. And Section 7 has these attribution rules that cause income attributed to a donation to be taxed in the hands of the donor. Now, we saw in 2023, in fact, it was effective 4 years of assessment commencing from 1 March 24 onwards, that the flow-through rule in Section 25B was amended to only apply when your beneficiary is a resident. I'm sure you're all aware of that. Now what they want to do is take that a step further to say we also want to change Section 7.5 and Section 7.6 to only apply when the donor is a resident. So what we're going to see coming through here, if we look at the amendment to Section 7.5, now Section 7.5, as I say, it's a deeming provision or an attribution. Income received by one person is deemed to accrue to another, being the donor in this circumstance, and in this particular case where Section 7.5 applies. And this is where a person has made a donation, settlement, or other disposition, and that could involve a low interest or an interest-free loan. There's an element of gratuitousness there. There's either no interest being paid or interest being paid at less than what would ordinarily be paid. So there's an element of gratuitousness that comes into this other disposition. All right. So donation, settlement, or low interest loan, which is subject to a stipulation or condition, whether made or imposed by the donor or anybody else. Could be the trust deed that has the stipulation that the income cannot be received by any of the beneficiaries until the happening of an event, whether fixed or contingent. Now, that happening of an event would be where you have a discretionary trust and you can't distribute anything to the beneficiaries until the trustees exercise their discretion. That's that happening of an event. And that's when Section 7.5 would come into play, when there's income in a trust that has not been distributed because we are waiting for the trustees to exercise their discretion. And in this particular case, that would cause the income to be taxed in the hands of the donor. Okay. Section 25B, excuse me for a sec. Section 25B would not apply because the income hasn't been distributed. It's still in the trust. But if the income relates to a donation, settlement, or other similar disposition, the income could be taxed in the donor. But the amendment is saying, provided that person is a resident at the earlier. So that's what's coming in here, the earlier of accrual or receipt of the income. So 7.5 will only apply where the donor is a resident. So if you've got income in the trust has not yet been distributed because the trustees haven't exercised their discretion through that tax year, so it's still in the trust, the donor is a non-resident or has become a non-resident. At the time that this income is received by or accrued to the trust, the donor is a non-resident, then 7.5 can't apply, and that would then leave that income to be taxed in the trust in that circumstance. And that, of course, is going to be at that 45% tax rate that applies to the trust. Okay, and then we see a similar amendment with Section 7.6. Now, Section 7.6, another circumstance where the attribution rule could apply. And this is where, again, if you've got a donation, settlement, or other disposition, like a low-interest loan, that has a stipulation that the right to receive any income thereby conferred may, under powers retained by the donor, effectively, or the lender, that person retains the right to confer on another or revoke the income. So they can change this. They retain the power. So we sometimes see discretionary trusts being set up as revocable. The person who sets up the trust retains the power to unwind the trust at some stage in the future. And there, that's just one example of where Section 7.6 could apply. So in the interim, while that person still retains that power, any income that flows as a result of that donation could be subject to Section 7.6, and in that respect be taxed back in the hands of the donor. However, going forward, this will only apply, again, if that donor is a resident. All right, so if the donor is not a resident, 7.6 would not apply, and then the income would remain to be taxed either in the trust or in the beneficiary, as the case may be. So these amendments to 7.5, 7.6 come into effect from 1 March 2026. And then we also see another amendment to 25B. So first of all, whereas we said Section 25B is subject to Section 7, which is what it said up until now they're being more specific, subject to Section 7.2 through to Section 7.8. So these attribution rules, okay, not all aspects of Section 7, because there are Section 7 goes all the way from Section 7.1 through to Section 7.11. And not all of that is relevant in a trust situation. All right, so it's subject to those provisions, to be more specific. And then in Section 25B1, they are then splitting into 2 subparagraphs. Subparagraph A will be where the trust is a resident, and that keeps the existing wording as amended from 1 March 24, to the extent to which any amount is derived for the immediate or future benefit of an ascertained beneficiary who is a resident, okay, then it's taxed in the hands of that beneficiary, otherwise it's taxed in the trust. And the other scenario is where the trust is a non-resident. So here we could revert back to the original wording, which basically says that if it's been derived for the immediate or future benefit of an ascertained beneficiary, not just who's a resident, any beneficiary, but this is now coming through a trust that's not a resident. When would that income even come into the scope of South African tax legislation? To be only where you're talking about South African source income. Okay, then potentially you would have income that could be taxed, but it's flowing into a non-resident trust and then being distributed to other beneficiaries, and there the flow-through rule would apply whether the beneficiaries are resident or non-resident. So that just clarifies that situation. All right, again, coming into effect from the 1st of March 2026. Okay, so those are all the amendments affecting trusts for now. And as I say, it's going to be interesting to see going forward if we then have a bit of a break from trust amendments in the future. But, well, that remains to be seen. They do give this example from the explanatory memorandum. So we have a resident trust, and we've got donations from a resident and a non-resident, each donating R1 million. That's a straight off donation, all right, to the trust. And the trust then invests that money and earns a return, 10% return. So 100,000 relating to A's donation and 100,000 relating to B's donation. So income arising as a result of a donation into a discretionary trust, and the trustees have not exercised their discretion during the year of assessment. So we would look at section 7.5, but now going forward, section 7.5 will only apply where the donor is a resident. And so the 100,000 relating to A will be taxed in the hands of A, but the 100,000 relating to B, the non-resident donor, would not be taxed in B's hands. So 7.5 does not apply in that respect. And that leaves that income to then be taxed in the trust. And that'll be taxed in the trust at the trust tax rate of 45%. I just think while we're talking about these aspects of amendments to trust legislation, income tax effects, and so on, it's always important just to make sure that your trust deeds are still relevant in terms of the tax legislation. So it's important to take this into account and just have a look at the trust deeds, what the trust deeds are providing, and make sure that they are in line with the legislation as amended. Let me just see if there's any questions here. Yeah, so would this apply to special and testamentary trusts? Yeah. So in this regard, yes, but remember that with a testamentary trust, well, it's possible a testamentary trust could still have donors that are alive donating into that testamentary trust, So yeah, to the extent to which these provisions apply, it's not specific only to an inter vivos discretionary trust, because each trust is unique. So yeah, potentially it could apply to any of these kinds of trusts. Right. Any other questions? I'm not seeing any other questions coming through there. So let's go on to our VAT amendments for a couple of minutes, and then we'll take a break. Now, I've mentioned a few VAT amendments there, debit and credit notes and so on my list of VAT amendments. I'm not going to talk to all of those amendments because some of them are very procedural, administrative. This one is interesting to refer to because it's actually granting a concession, believe it or not. There's not too many concessions that we are seeing coming through these amendments this year. But this is a concession that is granted to vendors who carry on testing services. Now, when you read the explanatory memorandum, they are talking about laboratory testing services. I think it's a bit of a problem that they haven't specifically defined that in the legislation. So even when you look at the Taxation Laws Amendment Bill, as it stands, these amendments just stand on their own and refer to testing services. I think they have to include a definition of what they refer to as testing services. But as I say, what they mean is laboratory testing services. So they're looking at a situation where clinical trials are conducted in South Africa on behalf of offshore clients. So you might have clinical trials being conducted in South Africa, and that's for the benefit of, let's say, a German pharmaceutical company. So the client is offshore, the testing is done in South Africa, but the problem is that it's not likely to be zero rated because that work is done. The question is it done while the person is non-resident? Because the actual testing is done on people who are in South Africa at the time the testing is done. So it becomes a little complicated to work that one out. And also, if you're talking about movable property, that movable property being the goods used in the testing, that's not going to be subsequently exported. And so it's difficult to fit into the existing zero rating provision of 11.2L. And so, as I say, they're introducing two brand new provisions to address this, to enable these supplies to be zero rated. So 11.2Z will zero rate the supply of testing services and reporting to non-residents. And 11.1X is introduced to zero rate the goods that are provided with those testing services. Yeah, so a concession, I mean, being in a zero rating situation is the best possible situation for a vendor, because if they are providing zero rated supplies, all of their supplies are taxable supplies. So although they're taxed at the zero rate, that is still a taxable supply. And it means that they can claim all of their input tax credits, whereas otherwise you would not be able to claim input tax credits if you are making exempt supplies. All right, so zero rating creates the best possible VAT situation, although the downside, of course, is that you're going to be subject to SARS audits every time you claim a refund, because all of your input tax is claimed and you have no output tax, so you end up with a refund on every VAT return that is submitted. So yes, an interesting amendment that comes through there. And I think that's probably a good time to take a break. I think what time? It's 26 minutes past 2. So we'll take a 15-minute break and we'll be back at 14, what will that be? 42 or so. All right, I'll leave it to Danny to maybe put a ticking clock on, and I'll also just pop into the chat box, but we'll take a 15-minute break and we'll see you back just now. Right, welcome back. And we can get going again. Okay, I see the Section 93 question, and I think, yeah, look, I'm not sure that it was really something that would be suitable for a reduced assessment, because I'm not sure if it would be regarded as a readily apparent inadvertent error. Yeah, so, well, yeah, the jury's out. Not, as you say, not your problem anymore. So it's now somebody else's problem. It's just unfortunate. I think the objection would have been the way to go, but it seems that door had been closed for whatever reason. Yeah. Okay. Let's see. A married couple are the founders and donate to a trust. One spouse dies. Can all income be attributed to the surviving resident founder? Well, it does come back to that married couple each have made their own donations to the trust. So to the extent that the income relates to the donations made by the deceased person, those would not be subject to the attribution rules. It would be to the extent to which the income is attributable to the donations made by the person who is still alive. So yeah, you'd have to sort of apportion and then decide on that basis how much would be kicked back to the donor, if anything. Okay, I just wanted to see, for some reason, I'm not seeing now the chat box, but okay, I think let's just take this over here and see if I can get it to come up. Yeah, I don't know. I don't know why I'm not seeing the chat, which is a bit unfortunate because it means I won't. Oh, there we go. There we go. I've got it back over here. Right. Okay, so let's carry on having a look at the amendments then. And the next lot that we are going to have a look at, still on the VAT side. Now there's an amendment that's coming through following on from the Capitec case. And the Capitec case, of course, that was a constitutional court case from 2024. You may remember it from last year's update. But Capitec, being a bank, they would have mixed supplies, but that wasn't the issue here. The issue here was that Capitec had claimed a notional input tax credit under Section 16(3)(c) of the VAT Act. And that is a specific input tax, well, it's a notional input tax because no VAT has actually been paid, but it's an amount equal to the tax fraction of any payment made by the vendor to indemnify another under a contract of insurance. Now, SARS had disallowed the input tax on the basis of saying that this was not made in the course of making a taxable supply because the insurance had been provided to the clients free of charge. And this was part of Capitec's business model at the time. They were granting unsecured loans. And as part of their business offering, they would provide free insurance. And yeah, so linked to that, they then wanted to claim this notional input tax credit, and SARS said, no, you can't, because this is not made in the course of making taxable supplies. But having gone all the way through to the Constitutional Court, that Constitutional Court then held that the supply of insurance was indeed a taxable supply because it was related to the overall business offering of Capitec. So even though there was no specific consideration charged, but it did raise a kind of a deeper, more technical question as to whether there was indeed a contract of insurance. So as I read to you there from 16(3)(c), we're talking about a notional input tax, the tax fraction on an amount paid to indemnify somebody under a contract of insurance. And this definition of insurance, as it stands in the VAT Act at the moment, simply says insurance means insurance or guarantee against a loss, etc., etc. It doesn't specifically say that any premium is payable, and SARS was of the view that they need to change that definition. And so that's what's coming through now, because they feel that the judgment is going to allow, you know, a bit of an open door on input taxes. Not sure that's really the case. It's certainly not going to undo the Capitec case judgment, this amendment, because it's going to come into effect from 1 April 2026 onwards. And in the meantime, Capitec has changed their business model in any event as far as the free insurance is concerned. But SARS does want to ensure that to clarify going forward, and so they're going to amend the definition of insurance to say it can only be insurance when a premium is charged. And they'll also introduce a definition of what they mean by premium. So that'll come in from the 1st of April 2026. And then the amendment around schools. And this is, I think, whether it's going to have the impact that that the submission entities were concerned about. There were quite a few submissions made on this proposed amendment. I've also seen a number of articles being written by VAT experts who are concerned about the impact of this amendment, that it's going to result in cash flow implications for schools. So it links to the fact that educational services supplied by schools, universities, higher education providers, etc., those services are exempt, all right? And it even goes on to speak about ancillary educational services. So other services that are linked to the services, the educational services, as long as it's all covered by the fees, etc., that are charged. So it might be books that are provided to students, maybe extra lessons and so on, all related to the educational institution. But now, going forward, the amendment is going to say that all supplies made by schools registered under the Schools Act will be exempt supplies, unless the supplies are made by, in the course of carrying on welfare activities by welfare organizations. So the issue is all supplies. So currently, if you have schools that are getting fees for educational services, that would be exempt supplies, but the schools might also be deriving third stream income from renting out facilities like halls, sports grounds, swimming pools, whatever the case might be. And they might sell other things that are not closely related to educational services to generate additional income. And that other income stream would be currently would be taxable supplies. So then you have schools having mixed supplies, both taxable and exempt supplies. But this amendment will say all supplies, if they are supplies made by a school registered under the Schools Act, then any supplies will be exempt. And that means that those schools would then fall outside of the VAT net altogether. Now, that's all well, good and fine, and that will happen from the 1st of January 2026. But it could result in some schools having to deregister for VAT. And that would trigger an output tax potentially, because on deregistration, the vendor is deemed to be supplying any assets still on hand, supplying those at for consideration, the lower of original costs, the cost on which that was applied, or current market value, the lower of, all right? So if the school owns any assets on which it claimed input tax in the past, it would have to effectively pay back that input tax to SARS. Now, because it is realized that that could result in quite a big cash outflow for schools, there is the relief that is given that the payment will be done over a period of 12 months from 1 January 2027. So the deregistration, or the fully exempt situation, which would trigger deregistration, happens from 1 January 26, but the tax that becomes payable as a result of the deregistration only has to be paid from 1 January 27 and over a period of 12 months. So it is a concession given in terms of the repayment period. And as a further sweetener, past assessments before 1 January 26 won't be reopened by either SARS or the vendor. But I can assure you that on deregistration, there would be a very stringent audit that would be done to make sure that all the necessary output tax is raised at that stage. And then, of course, the repayment has to happen. So it may or may not, depending on the schools, of course, involved, some may have no effect, others might have a significant effect. It just depends on the circumstances. In the explanatory memorandum, they give this example of a school that built an aquatic center. So that is the asset, as it were, cost 30 million exclusive of VAT. So that on that 15% of 30 million, 4.5 million. And if the school had an apportionment ratio, so it was saying taxable supplies comprised only 2% of total supplies, then it would only have got an input tax credit equal to 2% on 4.5 million, 90,000. And so on deregistration, it's that 90,000 that would have to be paid back by SARS from 1 January 27 over a 12-month period. So yeah, in that situation, that amount is not alarming necessarily, But of course, it is alarming if you don't have that money in the bank and you have to go out and find it, because then you've got to go back to the parent body and get them to pay the money in to pay this VAT back to SARS. But at least it does mean that going forward, schools will be off the radar screen as far as SARS is concerned, and they won't then have all the complexities that come with being a VAT vendor. All right, so an interesting one coming in from the beginning of next year. And then the next VAT amendment is this one here, dealing with low value imports. And here we have import VAT, which is imposed under Section 7(1)(b) of the VAT Act. Any goods imported by any person, you're supposed to pay VAT on those imports. And it's based on a formula dealing with the customs duty value, maybe with an additional 10%, etc. But if the goods have a value of 500 Rand or less, then there's an exemption. Or it talks about books, newspapers, journals, and periodicals imported by post, if that actually happens, not exceeding 100 Rand in value, then those are exempt from this import VAT. But that does create an imbalance, because, you know, if you go and buy an item on Temu that costs 400 Rand and you don't have to pay the import VAT, whereas if you bought the equivalent item from a South African vendor, you would have to pay the VAT. And so it is unfair in terms of creating an unlevel playing field. And so they're going to be deleting this exemption. But the effective date is not certain yet. It'll come into operation on a date to be announced by the minister. So there'll have to be a notice published in the Gazette to announce that. Right. And then the next one, we get on to the administrative amendments. And this is in the TALAB. As I say, these amendments not just to the Tax Administration Act, but also to the Income Tax Act and the VAT Act. Now, the Income Tax Act, Section 18, these are the certificates that have to be kept by the 18A entity to confirm that the donations that they've received, which qualify for tax deduction in the hands of the donor, they must be used for the carrying on the activities of the Section 18A institution. All right, and so this certificate has to be generated. Now, at the moment, it talks about an audit certificate, and it has to confirm that all donations received or accrued for which receipts were issued must be used solely to undertake activities covered by Section 18A. This uncertainty around the words audit certificate, does that mean that only auditors can sign off on that certificate, registered auditors? And so now they're changing the wording to clarify that it doesn't have to be an audit certificate per se, but it must be a certificate containing such information as the Commissioner may prescribe by public notice, so that is still to come through, confirming the reasonable satisfaction of a registered tax practitioner. So it doesn't have to be a registered auditor signing off on the certificate. With a PBO, it can be a registered tax practitioner, and they don't have to do a 100% verification audit. They just have to get a reasonable satisfaction that all donations were used for the activities as specified. If you're dealing with a PFMA entity, then you're looking at the accounting officer that would sign off on that certificate. Again, not an audit certificate, but again, contain the information prescribed by the Commissioner in a public notice. Yeah, so that is an amendment that SAICA did get very involved in. I see they made submissions on that, and they've driven pretty hard to get that amendment coming through in a practical and realistic way. And I think, yeah, this certainly is an improvement on the wording that was there before. And then there's some amendments in the VAT Act, administrative amendments. In Section 1, introducing definitions of e-invoice, e-debit note, e-credit note, and e-reporting system. And that speaks to the fact that SARS is moving towards this fully electronic, online, real-time reporting system for VAT. And so in order to work with that system, vendors will be required to have invoices and documentation that is machine readable. So you'll be able to upload all of that to SARS, and they would be able to do their risk analysis and verification, etc., on a real-time basis. Really almost moving to the point of the large vendors where SARS could basically draw that information out of the vendor's accounting system on a real-time basis in terms of what the VAT liabilities will be. So it may ultimately mean that you wouldn't have to submit your VAT 201 return every year, every month, or every tax period. that SARS will be able to draw that information out of that accounting system. But yeah, so they're working towards this. They say this full modernization will go live in 2028. But of course, it doesn't mean to say that you're all going to be fully online real time in 2028. I mean, it might take a bit longer for the average vendor, but certainly SARS is working towards this. So yeah, quite an interesting development that is coming through there. Just checking that there's no questions. All right, so these amendments with these definitions, and then section 74 is just going to allow the minister to pass any additional regulations that will facilitate any additional administrative requirements for this VAT modernization project. Then on to the audit process and into audit and verification. And we're into the Tax Administration Act now. And in terms of Section 45 of the Tax Administration Act, this does contain various provisions where SARS can conduct inspections. And at the moment, it says a SARS official may, for the purposes of the administration of a tax act and without prior notice, arrive at a premises where the SARS official has a reasonable belief that a trade or enterprise is being carried on and conduct an inspection to determine only the identity of the person occupying the premises, whether they're registered, whether they're complying with sections 29 and 30 of the Tax Administration Act. So in terms of SARS arriving at a taxpayer's premises without a warrant, it's only in those very limited circumstances that that is permitted because of the right to privacy that exists in the Constitution. Now they are expanding that to a fourth situation. So I read three: verifying the identity, verifying whether the person's registered, verifying whether they're complying with section 29 and 30, which talks about keeping records and retaining records. And the fourth one will be where SARS wants to verify a person who's applying for voluntary VAT registration. They want to verify that the business address is correct, that there is actually something there, and that the premises are conducive to the activities reflected on the application. All right. So if you're saying that you're going to be carrying on a business manufacturing widgets, then they want to see whether, you've said you're going to operate at 223 Pochenpoel Avenue. They want to see, is that a valid address, and are the premises realistic in terms of carrying on that particular operation? All right, so that's just going to be an interesting one to as further verification. I don't know if this is going to slow down the VAT registration process even further. I understand it already can be quite lengthy, but yeah, it remains to be seen what the impact of this is. I see that there is a question that's come through. When a VAT return is submitted with a refund and SARS do not initiate an audit, does the 21-day turnaround time still apply? I have clients where VAT refunds are not being paid, but no audit. And then we call SARS, we get told there's no turnaround time. Well, the 21-day turnaround time is from the date that SARS has received all the necessary documentation. So yeah, that does apply. But I do know that getting refunds paid out at the moment seems more difficult than ever. It's obviously part of the SARS targets on revenue collection that they're trying to minimize refunds in every possible way. It doesn't mean to say that they are correct, though. So people do need to know the law and exercise their rights. Okay, so section 164. All right, so this amendment here, it's dealing with the application for suspension of payment. Now, where a person has a dispute with SARS, of course, going back one step, we have the pay now, argue later principle. And if a person has a dispute with SARS, you have an assessment that you disagree with, you're going to object to the assessment. As you know, you would also simultaneously or even first apply for a suspension of payment to make sure that the payment is suspended while that dispute is being resolved. But that suspension of payment only applies where there is a dispute, which doesn't really cut into the situation with auto assessments. With auto assessments, there's not necessarily a dispute, certainly not at the outset. SARS raises an assessment, and of course the taxpayer has to ensure that that assessment is correct and complete. All that the information that SARS has is complete in all respects, and if not, the taxpayer would submit the outstanding information, and then there'd be a revised assessment that is issued. Now, it could be a reduced assessment if the taxpayer submits a tax return with additional tax deductions or maybe additional medical credits. It might result in a reduced assessment. So, I mean, if we had, for example, an auto assessment raised in July showing tax payable of 100,000 Rand, and that was payable end of August. So in the meantime, the taxpayer then submits documentation and a tax return to show deductions or additional medical credits or something like that. So maybe the reduced assessment comes out in November and indicates tax payable not of 100,000 but of maybe 30,000 Rand. But the issue is, what about that 100,000 that was paid at the end of August? Now, Section 164 didn't cater for a suspension of debt in that circumstance. In practice, SARS said that they did allow the application for suspension of payment, but it wasn't specifically in terms of the legislation. All right, so now they're going to put this amendment in to say with auto assessments, that could be another situation that you could apply for a suspension of payment if you're expecting a reduced assessment based on the submitted return. Okay, let me just check that there's no questions coming through. Right. Then we go on to the next one with trustees appointed as representatives of an insolvent person. Take note that they're going to amend Section 153 to confirm that the liability of the trustee in their representative capacity also extends to any income received or accrued prior to sequestration of the estate. And then we get on to the big one for this year, which is the amendment around understatement penalties. Now, remember, first of all, that when we look at penalties charged by SARS, we have different penalty provisions. You have your administrative non-compliance penalties, and those are charged under Chapter 15 of the Tax Administration Act. That can be your fixed amount penalties for failure to submit tax returns, and it can also be your percentage-based penalties, 10% late payment, your underpayment as a result of an underestimate on provisional tax, that sort of thing. Those are your administrative non-compliance penalties under Chapter 15. And then you get your understatement penalties, which come through Chapter 16. And these penalties are charged where there is an understatement. But currently, Section 2221 says, in the event of an understatement, the understatement penalty must be charged unless the understatement results from a bona fide inadvertent error. So there's this broad-based exclusion that says that there's no understatement penalty if an understatement arises from a bona fide inadvertent error. So what the issue has been, what exactly is a bona fide inadvertent error? And here there's been quite a big divergence in interpretation. So SARS, in their guide to understatement penalties, alleges that a bona fide inadvertent error can't be anything more than just a capturing error, where you literally just make an error that you were completely unaware of because you just had a slip of the keyboard, missed out a naught or added in a naught, as the case may be. That's the only thing that could give rise to a bona fide inadvertent error. But the courts, on the other hand, and we've seen a number of cases over the last few years where taxpayers have been subject to understatement penalties. And let's say, for example, the taxpayer has claimed a deduction, which ultimately turns out that they were not eligible for. But the taxpayer argues that they claimed the deduction on the basis that they had an opinion from an expert who said they were eligible for the deduction. So they claimed it in good faith based on the tax opinion. And although it turned out that they were wrong, and so they ended up being an understatement, in that case, well, in many of these cases, the courts held that that understatement did arise from a bona fide inadvertent error because the taxpayer acted in good faith, did the best they could, relying on the opinion of an expert, and therefore there should be no understatement penalty. And so that was broad-based. It didn't refer to whether we were dealing with a substantial understatement or just any other kind of understatement. But now SARS has said that the concept and scope has proven to be contentious, and the concept is not really used like this in other frameworks elsewhere. And they talk about a mix of purely factual tests versus more subjective tests. Now, when they talk about factual tests, they're talking about substantial understatement. And that links, I'm just going to jump forward to the table here. So this is the understatement penalty table in section 223, right? And what would ordinarily happen is that you would say, is there an understatement? Now, what is an understatement? An understatement is defined in section 221 as any prejudice to SARS or the fiscus as a result of failure to submit a return, an omission from a return, an incorrect statement in a return, if no return is required, failure to pay the correct amount of tax, or fifth, where there's an impermissible avoidance arrangement. And that term impermissible avoidance arrangements comes through from section 80A of the Income Tax Act, the General Anti-Avoidance Rule, section 80A through to L. And that is really talking about a tax avoidance scheme that the taxpayer has entered into, sole or main purpose to avoid tax. And SARS has applied the GAR provisions, and they've said it's an impermissible avoidance arrangement, and then SARS assesses the taxpayer, raises an additional assessment as if the taxpayer had never entered into that arrangement. So that situation where there's been an impermissible avoidance arrangement falls into this definition of understatement. All right, so failure to submit a return or doing something in the return that results in there being a prejudice to SARS. And then what would happen is that once you've established that there's an understatement and it has not arisen from a bona fide inadvertent error, that would be the route that we do currently, then you look at the table and say, what gave rise to that understatement? And depending on the behavior and the circumstances, these 4 columns here, you would then work out what, or SARS would do this, right? The onus is on SARS to establish the basis on which the understatement penalty is charged. So let's say that this deduction was claimed by the taxpayer and it turned out they weren't entitled to the deduction, but we're saying it's not linked to a bona fide inadvertent error. SARS would say, all right, there was no reasonable grounds for that tax position taken. Standard case, obstructive or repeat case. And then, of course, these last 2 columns are where there's a voluntary disclosure. Best case is the last column, voluntary disclosure before SARS started auditing the taxpayer. Otherwise, voluntary disclosure after audit, but SARS allows the VDP to go ahead. And then the first 2 columns, standard or obstructive, is where there's no VDP. So if SARS came in here and said no reasonable grounds for the tax position, it's a first offense standard case, it'll be a 50% penalty on the amount of the shortfall, the tax shortfall, which is the difference between how much tax the taxpayer said was payable versus how much tax is properly chargeable based on, SARS additional assessment once they've disallowed the deduction of those expenses. Now, the first line here, you'll see it refers to substantial understatement. So this is the objective test that SARS refers to. Substantial understatement, as you can see, it's got inverted commas. It's a defined term. And it means a case where the prejudice to SARS or the fiscus exceeds the greater of 5% of the tax properly chargeable or R1 million. So you could say it's a de minimis of R1 million and up is your substantial understatement. All right, so substantial understatement without any of these other behaviors applying, just the mere fact that it's a substantial understatement kicks in at this level, and then that particular percentage would apply. Right, so what's going to happen is that the way that these penalty provisions are being amended is that whereas currently there's this broad-based exclusion where there's a bona fide inadvertent error, going forward, the amendments are going to ensure that this bona fide inadvertent error escape clause is only going to happen when there's a substantial understatement. All right, so only where this first line applies, only then could you raise the argument of bona fide inadvertent error. So if you don't have a substantial understatement, sort of R1 million and upwards, then you're looking really at these behaviors, all right, and which behavior gave rise to the understatement penalty. And I'm going to come back to those behaviors just now. But just to get back to this, so what SARS is saying is that you could only raise this argument of bona fide inadvertent error where you have a substantial understatement not based on one of those bad behaviors, but just on this objective amount. Remember, it's the amount being the greater of 5% of tax properly chargeable or R1,000,000. So if we look at these amendments, section 2221, you'll see that they are adding in some words and they're taking out these words that say, unless the understatement results from a bona fide inadvertent error. So that'll no longer appear in this provision. It will appear in another provision, but not in this one. So what will happen once this becomes effective, which will be from the date of promulgation, is that section 222 will read as follows. In the event of an understatement, as defined by a taxpayer, that involves a behavior listed in that table, the taxpayer must pay, in addition to any tax, the understatement penalty. So if we've got an understatement that involves any of these behaviors, then the understatement penalty becomes payable. And so the implication is, if you've got an understatement that does not involve one of these behaviors, so there is an understatement, but it's not due to any of these things, as for some other reason, then there would be no understatement penalty. So that is changing the ground rules, I think, compared to what we have now. SARS says it's not really, but I think for many people, they do see it as quite a substantial change. Moving the words bona fide inadvertent error through to section 2233. Now, this 223 subsection 3 has been in the Tax Administration Act all along, dealing with when you can get an understatement penalty waived in the circumstance where there is a substantial understatement. So it applies very specifically when there's a penalty for a substantial understatement, okay, upwards of R1,000,000. Then you could get that penalty waived if either you can show that it results from a bona fide inadvertent error, which might be that you were relying on expert advice. Yes, the courts have indicated that could be the case. Or SARS is satisfied that you've made full disclosure of a section 34 arrangement. So that's an arrangement as defined in section 34. And section 34, I'll just tell you what that specifically refers to. That is talking about a reportable arrangement. All right. So if you have a reportable arrangement that you have to report under section 34 of the Tax Administration Act, and you've made full disclosure of that arrangement, and you have an opinion, and that meets all of these criteria, this is the same as what was in the legislation before. So this hasn't changed. Okay. It's still there. But the key thing is that we're saying when you have a substantial understatement, your grounds for waiver are either bona fide inadvertent error or full disclosure of a reportable arrangement with a tax opinion, etc. Either of those two circumstances. Then you could get the penalty waived for a substantial understatement. But if you're dealing with any kind of understatement that falls below substantial understatement, below that R1,000,000, then the penalty is going to apply if one of these behaviors gave rise to that understatement. And if you're able to show that none of these behaviors were involved, then that would be your grounds for arguing that the understatement penalty should be waived. And so in the explanatory memorandum, they sort of play this down and say, look, it's always been the case that taxpayers who do not engage in unacceptable behavior don't get subjected to understatement penalties. And they say it'll continue to be the case. So they're saying this is carrying on what was there before, but we're just clarifying the wording. And so they're saying that it's always been the case that if you did not engage in unacceptable behavior, then you would not have an understatement penalty. The unacceptable behavior being failure to take reasonable care. You see all these things that are listed in this table here. Where is that table gone? Okay, these things: unacceptable behavior, reasonable care, no reasonable grounds, impermissible avoidance arrangement, gross negligence, intentional evasion. So they're saying if you don't engage in any of that unacceptable behavior, then you won't be subject to an understatement penalty. All right. But going forward, so you won't be able to just use the bona fide inadvertent error argument. You can only use that argument if you have a substantial understatement. Bearing in mind that the burden of proving the facts upon which the understatement penalty is based remains on SARS, but the thing is that the taxpayer still has to, if you want to get this penalty remitted, you have to be able to show how it is that you qualify for remission in terms of the wording of the section. Now, there was a number of submissions on this because, yeah, people were very concerned about this amendment. And SARS and National Treasury went to great lengths to try and explain that it's not such a big deal. And where people were saying that there's prejudice, people who have smaller understatements are prejudiced because people with large understatements, substantial understatements, here, you know, let's say an amount of more than 2 million rand, there you could rely on the bona fide inadvertent error argument, whereas somebody with an understatement of 25,000, it looks like they are just going to be subject to the understatement penalty, and there's nothing you can do about it. But SARS and National Treasury go to great lengths to explain that if there's no sort of bad behavior that gave rise to that understatement, then there should be no penalty. And so I really stress that that would have to be the basis of your argument going forward if you want to get an understatement penalty remitted and if it falls under R1 million. Okay, now it's interesting. So let's see here. If a taxpayer with a 25,000 rand understatement took reasonable care and they have reasonable grounds for the tax position, they would not incur the understatement penalty because they don't have a bad behavior. And they say it is well established that reliance on professional advice prior to taking a tax position is generally regarded as reasonable. So they're saying here that if you relied on an expert who said you can claim this deduction and you ended up with a 25,000 rand penalty as a result, your argument there to get that penalty remitted would be that you did take reasonable care and skill, and there was reasonable grounds for your tax position. And if none of these other behaviors applies, on that basis, you would apply to get the understatement penalty waived. Yeah. Okay, so that's why I've put in all the detail of their response to the submission so that you can see what they're saying along these lines, and it might help you if you are having to formulate a request for remission of an understatement penalty going forward. Okay, so that's the story on the bona fide inadvertent error. Then the last part of the webinar, and we can jump through this fairly quickly because we actually did a webinar dealing with the tax judgments of 2025 not long ago, and we would have covered these judgments. And I've given you live links to all of the judgments, but just the overview there. So the big one from the Constitutional Court was that 5-part court case. There were actually 5 taxpayers, 5 appellants involved. Separate cases though, all right? So it was United Manganese, ABSA, Louisville, Rapper Resources, etc. I can't remember the 5th one, but there were 5 different cases involving Section 105 of the Tax Administration Act. And the key thing that came through this very well-written judgment, very lengthy because it's actually 5 judgments in one, but it really, it shows the factors that should be taken into account when you're trying to take a case to the High Court under Section 105, you're looking for a review, an application for a review, or an application for a declaratory order, and you want the High Court to consider that. What would be the factors that might indicate that the High Court should look at that, as opposed to going the normal dispute resolution process? Okay, so an interesting judgment there. And then on SCA, Arendse was looking at claiming input tax deductions on entertainment expenses. Linked to putting employees up in hotels and B&Bs and paying for accommodation and food. Now, although generally speaking that on entertainment is disallowed, there are some exceptions. The one being that if you're providing food and accommodation to employees or other persons, you're doing so at a fee that covers all your direct and indirect costs, then you would be able to claim the input tax on the entertainment costs. And here, Arendse was trying to demonstrate that they were charging a fee that covered all of their direct and indirect costs, but the SCA said at the end of the day that they had failed to discharge the onus upon them to show and prove that that was the case. So that Arendse actually lost that case. Henk was a business rescue situation looking at when does a tax debt come into existence, and the holding of the SCA was it comes into existence through the transactions that happen, and therefore at the end of the year of assessment is when the tax debt actually comes into existence, or in the case of VAT, at the end of a tax period. Virgin Mobile was a case involving a dispute resolution with SARS, where SARS had failed to produce their Rule 31 statement within the requisite time. Virgin Mobile then brought a Rule 56 application, which is basically putting SARS on notice to say either you produce the outstanding documentation, or we as the aggrieved party are going to apply to the tax court to get a Section 129 application, which would mean the tax court could actually overturn that additional assessment raised by SARS. And SARS, I mean, Virgin Mobile had been successful in the High Court. SARS then took this on appeal. And what had happened is that Virgin had been telling SARS that they were overdue with their Rule 31 statement, going on for like 18 months. And then eventually Virgin Mobile issued the Rule 56 notice, and that has a 15-day deadline. And within 5 days, SARS produced the outstanding Rule 31. So SARS said then that they were no longer in default. But Virgin Mobile said, you're still in default because you never applied for condonation, you never applied for extension. Well, interesting, when SARS took this on to the SCA actually took SARS' side in this. And they said, well, you can't just allow Virgin Mobile to now just go to the tax court with a Section 129 application, because that has an extreme outcome in that SARS additional assessment could be overturned by the tax court. And they said that would be extremely problematic. We need to allow all these matters to be properly ventilated. And they then basically turned on the taxpayer and said, you took too long to issue this Rule 56 notice. And Rule 56 is a really important remedy for taxpayers when you're dealing with SARS, because it talks about when a party is in default. So if SARS goes beyond the deadline on any of these issues, then you can bring that Rule 56 notice to say to SARS, if you don't come to the party within 15 days, we're going to take this, we're going to do an application to the High Court for a review of the assessment. Not the High Court, the tax court, sorry, under Section 129. Yeah, so the SCA said Virgin Mobile dragged their feet. They should have applied earlier, and this matter should not proceed to the tax court. All right, and then Woolworths was an input tax deduction by a holding company. SARS had denied it, saying the holding company was not carrying on an enterprise, but the court at the end of the day concluded this was not just a passive holding company, it was an active management company, and it was carrying on an enterprise, and therefore it could get those input tax deductions. African Bank was a bank with mixed suppliers, and they were applying to SARS for a ruling around their apportionment of input taxes. And then SARS issued them with a different ruling to the one they had asked for. And African Bank appealed against that. They actually lodged an objection, and SARS said this is not something that can be objected to. But actually, if you look at the wording in the VAT Act talking about what decisions of SARS can be objected to, it talks about refusal to issue a ruling when requested. And the fact that SARS had issued a different ruling to what had been asked for, the SCA said fell within the ambit of that. And therefore it could be objected to, and African Bank was quite within their rights to take this matter on objection. And SARS needed to go back and relook at that ruling. And then the lion match, just a warning, just like earlier in Virgin Mobile, we're talking about Section 129 that could allow the tax court to overturn an assessment raised by SARS. On the other hand, if the taxpayer doesn't represent themselves, and SARS does in a tax hearing, the tax court has the ability to upwardly adjust a tax assessment. So it can go both ways. That was the warning in the lion match company. And the High Court Suku was a preservation order, just looking at the scope of a preservation order. Cobain looked at the objection and appeal process. And here again, coming back to that question of objections and when you are out of time on objections. So here, the taxpayer just keeps lodging objections even though they were out of time. They should have gone back and followed the proper process of applying for a condonation of late submission of an objection. And if SARS refused that condonation, that is a decision that can be objected to in itself. So yeah, they obviously didn't properly apply the dispute resolution process. They ended up then jumping to the High Court to ask the High Court to intervene. And the High Court said no. This is not a Section 105, linking back to the United Manganese. This is not a matter that should be brought into Section 105. You must go the normal dispute resolution rule. And if you're out of time and by now you've lost your 3 years, then it's just too bad. And then HR Focus was a payroll and HR management company, administrative company, and SARS was seeking to tax them as if they were the employer of all of the employees for whom they were running pay slips and so on. I won't get into the detail of this. SARS is not entirely to blame for coming to that conclusion, but at the end of the day, the court said HR Focus is not the employer. They are just acting as an agent for the customers. And so the money that the clients were paying HR Focus used that money to pay SARS the employees' tax, to pay the employees their net salary, and there might be a margin of fee that is kept. And that fee is what would be subject to VAT. But SARS was saying that the whole amount paid by the clients should be subject to VAT because they were seeing HR as acting as a sort of a principal in that situation. But SARS was unsuccessful in that case. And then Prinsloo and others, these are liquidators of companies, 3 companies that were conflated under one umbrella company under Section 20, subsection 9 of the Companies Act. And that is a provision that can apply to cut through the corporate veil in a liquidation situation where people are trying to misapply and abuse the sort of protective mechanism of that legislative identity of a company. And so this provision allows you to cut through that for the purpose of recovering money in the liquidation process. But because there were 3 companies that were sort of coming under one umbrella for the purposes of Section 29 of the Companies Act, these liquidators were saying, well, then SARS should just recognize it as such as well and not look at each individual company. But the finding of the High Court was that Section 29 was a deeming provision for liquidation purposes only. For tax purposes, each company still retained its own identity. Right, so that's a big, swift move through all of the tax judgments for the year. These are the interpretation notes that have been issued in 2025, and I would really draw your attention if you deal with stock, trading stock, interpretation note number 140, which talks about this diminution. When do you write down closing stock? You see, Section 22(1)(a) requires that you add back to income any closing stock on hand, and it's a cost price minus the amount by which the stock has lost value, the diminution due to damage, deterioration, change in fashion, etc. And so this is saying, this is SARS interpretation of what you need to do to get this diminution recognized. Because in Section 22(1)(a), it says any amount that the commissioner considers reasonable linked to a loss of value because of damage, deterioration, etc., etc. Sorry about the phone. Okay, so quite important if you are dealing with stock. And then interpretation notes. These are the ones that have been updated in 2025. And there's quite a number of them, as you can see, often linked to changes in underlying legislation, like the sunset date on the learnership allowance and so on. So just be aware of that if you're dealing with any of those particular areas. Okay, and then we go on to public notices that have been published during the year. So these first 2 are linked to the budget speech and the new tax year with new subsistence allowances, your rate per kilometre for your travel allowances, your deemed expenditure. And then the next one is the notice for the 2025 filing season, all right, who has to submit a tax return. And then the next one links to that with auto assessments. So if you had an auto assessment and you had to submit an actual tax return, by what date did you have to submit that? And then the next one talks about Section 18A receipts. So the receipts issued to the donors, what information must be shown. So this replaces the previous notice and it comes into effect from 1 March 2026. So do take note of that if you're dealing with PBOs, 18A institutions. And then the last public notice deals with your international companies, globe information returns, etc., under the global minimum tax. All right, so yeah, so I don't know that any of you would really be affected by that, but just be aware of this if you are involved in any of those multinational companies. And I think that brings us to the end. So if there are any other questions, you're very welcome to pop them into the Q&A. I will attempt to keep a look here to see what questions have come through. But in the meantime, for the rest, if you don't have any questions, let me just take this opportunity just to say thank you very much for joining us this afternoon. I know that I have bombarded you with a tremendous amount of information, and I hope it has been useful and that there's something of value that you can take with you into your work life. And I pray and hope that you have a good end to 2025 and a great holiday season. And we'll hopefully see you soon in 2026. So thanks for joining. I'll leave it open for a few minutes for any questions, but otherwise just to say goodbye and all the best. Thanks then. Cheerio.
Yes, thank you. Thanks for an interesting afternoon, although and fast forward. Tried to keep up some very interesting, some interesting places. I'm sure everybody had an interesting afternoon. Your certificates, everybody will be on their way. Also doing catch up now for 2025. To go back further than that, let me know. You'll be getting notices, or you should have been notices about the 2025.
Nice.
That you, whatever
Nice. It was very. There is a
Sorry.
question for Jackie, but yeah, let's just first check that.
Hi. Okay. So the question, if a taxpayer has exceeded the VAT threshold but not charged VAT, they registered after the threshold was reached. Yeah, it's going to be a real problem because what the VAT Act refers to is that any person who was required to be a vendor. So technically they want the VAT from the time the person became liable to be registered as a vendor. And so at the end of the day, that's probably going to come out of the cash inflow to that person. So yeah, it does create a bit of a tax problem there. Okay, anything else? Sorry, Stan, I couldn't figure out what you were saying. It's coming,
Yeah,
not
let
coming
me
through
take
clearly
over
at
from
all.
Stan
But
because I think you're still a bit, your microphone's not working great again. So I want
yeah,
to thank you again, Jackie. It was great, always informative.
thank you.
Thanks to everyone for attending. Those who haven't have missed a few seminars, we are doing a catch up, and we'll send out notices in the coming days for you to catch up any of the courses we have held throughout the year. And otherwise, we wish everyone a happy festive season and a good break over the end of year.
So thanks for
Yes,
joining here. And Lenny, it needs
that,
back further than up, what's 24, 20 years. We can help to contact us. If you haven't received certificates for courses that you've attended, or you need invoices, please let us know. We'll try and catch up in the next few days. Or weeks. Again, for joining us this year. Thank you, Jackie, for an interesting afternoon. Thanks, Danny.
Yeah. So let me repeat what Stan was saying to those who couldn't hear. Stan was saying, so if you have it, even so, for those who have attended throughout the year, and you still just need a certificate reissued, just let us know. It is part of the catch up, where it has an option for those who have attended and just wanted to better record keeping to reissue a certificate. Just let us know. And anyway, all the best for everyone. Have a good year.